When economies slow down, governments have one key weapon in their hand, and that is fiscal policies. Hi, friends, welcome to Econverse. I'm Abrar, and I'm a fellow student who topped in my GCSE Economics exam last year in Oman. On this channel, we make learning economics simpler, clearer, and hopefully a lot more fun. In this video, we are going to be looking at fiscal policies. So let's get straight into it. This video, we're going to be looking at the first kind of policies, macroeconomic policy, fiscal policies. So, what are fiscal policies? So, fiscal policy essentially is fiscal is a word that's taken from a Greek word fisk, which basically means basket. So fisk means basket, so it's a set of policies that impact AD. So the important part of these policies is that they are taken in order to stimulate the aggregate demand. So when we look at fiscal policy, there's essentially two types of fiscal policies. Number one, you have your taxation, and number two, you have your government spending. These are the two main tools involved in fiscal policies. So when you look at these two, these are the main two tools. So now let's first go through the whole taxation bit. So when we begin with taxation, so when we start off with taxation, let's try and break this down as to which aspects of aggregate demand it affects. So it affects C, I, and net exports as well. So when we look at taxation, it can be split into two types. You have your direct taxes and you have your indirect taxes. So direct taxes are essentially the taxes directly on one's income. So you have it straight on income, which can be income tax for consumers and corporation tax for firms. And when we look at indirect taxes, these are the forms of taxes where the government actually collects the tax indirectly. So they're essentially taxes on goods and services. So these include, like, examples would be stuff like VAT, GST, sales tax, excise duty, so on and so forth. So now there's two key terms that you need to know. One is your burden of tax, and the other is the impact of tax. Now let's try and understand what each of these mean. Burden of tax essentially means the tax is taken from their income. So whoever has the burden of tax, it's from their income that the tax is paid, and the impact of tax essentially refers to tax payment made by this person. So essentially, in both of these cases, the key difference is that in the first case, with direct taxes, you have both burden and impact on your consumer. And when we look at indirect taxes, your burden is on consumers, but the impact is on firms. So the firms essentially end up paying the taxes, however the taxes is directly from the consumer's income. So this is some of the key overview of how taxation works. So now we need to understand, why do they even tax. Why would you tax products? So like I always do for anything related to reasons, I like to make it like a list. So firstly, you would do it to reduce consumption of demerit goods. So link this back to your microeconomic content. In order to reduce it, you could apply taxes. You could put taxes in order to prevent demand pull inflation. Now, demand pull inflation is when people have too much money and they're willing to pay more than the original price. So when you essentially snatch that away, you're reducing the chances for demand pull inflation. And then taxes play a massive role in the funds that allow for redistributing income. So you can tax the rich in order to ensure that the poor become richer in some ways, to ensure that they reach a better standard of living. Then you can also use taxes to penalize firms that have high external costs. So whenever you have external costs by the firms, externalities, again this relates to micro content. Externalities is when there's costs on unrelated third parties due to a firm producing a particular product. This could be stuff like pollution, traffic jams, so on and so forth. So it can be used to punish those firms, and it can also be used in order to protect domestic firms. So now you can have firms that try and become monopolies, that are multinational firms from other countries. So they would use monopolistic strategies, uncompetitive strategies that try and break the competition, such as they could set the prices way below even the profit margins in order to wipe out their competition, which could be domestic firms. So by taxing the foreign firms, you're essentially protecting your own domestic firms and industries. So these are some of the reasons for governments to use taxation. It is essentially to influence economic activity. So that is why taxes are used. Now we've looked at why they're used. Let's try and understand some different taxes. So when you look at taxes, there's actually one more key idea that we need to know. We need to know that taxes come of three types mainly. You have progressive taxes, you have proportional taxes, and you have regressive taxes. Now what does this mean? Essentially, when income rises and your rate of tax rises, this is what you'd call progressive. So as your income increases, the rate of taxation that you pay also increases. And when you look at regressive, it is the exact opposite. As your income rises, your rate of taxation falls. So your rate of taxes decreases as your income increases. And when you look at proportional, the rate of tax is the same. Nevertheless, of what income band you're in, the same rate of tax is paid by everybody. So these are the three main rates as of such through which taxes are applied. So now there are some key principles of taxes that we need to understand. Principles of taxation. So when you look at some key principles of taxation, they are firstly equity. So there should be equal ability for everybody to pay the tax. There should be certainty. It should be easy for everybody to calculate how much of tax that they are paying. There should be economy, which means there should be a process to collect taxes, and it should be quite cheap and easily accessible to everybody, and there should be flexibility, which means it should be easy for you to change your tax laws, and there should be efficiency. It should incentivize demand and supply, and it should not disincentivize them. So your usage of taxation should be it should be very apt to ensure that demand and supply are incentivized, that there should be higher demand and higher supply rather than decreasing demand and supply. We've finished looking at taxation. Let us move on to government spending. So when we look at government spending, it essentially goes on to affect the G part of the equation in aggregate demand. So examples of government spending could be stuff like welfare schemes, pensions, unemployment benefits. So what are some reasons for government spending? So some reasons for government spending are: number one, to again influence economic activity. So that is the basic idea. So that's your first reason. Number two, it could be to prevent recessions. It could be to reduce the extent of market failure, which we discussed again in micro. So as you can notice, a lot of microeconomics and macroeconomics end up intertwining together as you go on. They begin to link, and then you can say to promote equity, because equity and equality in society is basically the goal. And then you have to pay interest on national debt. Now this is slightly complicated. It's essentially when government spending is through bonds, which we look at in some of the future videos in A level. Now you can technically ignore that bit for GCSE. Now here's the main thing that you need to know when you relate it to government spending. You need to understand how budgets work. Now budgets come of three forms. You can have a surplus budget, you can have a balanced one, and you can lastly also have something called a deficit one. Now a surplus budget, it essentially is when your revenue that you make is greater than the expenditure. So as a government, when you make more than you spend, that is when you have a surplus budget. In terms of deficit, it is the exact opposite. It's when you spend more than you even make. You use debts, etc., in order to spend. And lastly, balanced budget is when revenue equals your expenditure. So we've looked at government spending as well. We've looked at taxation. Now finally, you can essentially break down fiscal policy into two types. You have expansionary and you have contractionary. Now what does this mean? Expansionary is when you're using the policy in order to rise aggregate demand. Now examples of these could be lowering taxation or higher government spending. On the other end, when you look at contractionary, it is essentially in order to decrease aggregate demand, and that could happen through more tax, could also happen through lower government spending. So that is all for this video related to fiscal policies. If you think you enjoyed this video, please make sure to give it a thumbs up and subscribe to join the Econverse for many more videos related to macroeconomic content. I'll see you again in the next video where we look at monetary policies.